Good afternoon, ladies and gentlemen, to this interesting topic of the webinar. I think there will be a lot of interest in today's webinar, given there is a lot more to sort of be positive on the markets, and we'll take you through a lot of data point that sort of facilitates our high conviction in terms of why this is a very opportune time to look at India from an equity perspective. And we are very sort of thumping on the table kind of data points which we will be presenting you. And obviously, you can be reciprocative by asking a lot of questions because such kind of data points you will not come across for a very long time. I think this is the time our CEO Sushant Bhansali is also very much there in the webinar, and he'll stay throughout the webinar to address all kind of questions you have on why should you also increase your equity allocation. But let's come to the fund performance to start with, and then Trilok will take you to a lot of macro slides, and obviously followed by Sushant concluding the webinar. In terms of coffee can portfolio, which is our largest flagship scheme, the month return is closer to about 1.2%. However, if you look at from a slightly longer horizon, then the 2-year performance continues to be fairly strong with an alpha of upwards of about 1.8% plus. In terms of key allocations, financials, automobiles, and retail continue to remain the top three in terms of sector allocation. Coming to Good and Clean. Yeah, so Good and Clean has really made a very strong comeback. As you can see on the first chart, which is the point-to-point return chart, across 1 month, 3 month, 6 month, 1 year, 2 year, 3 year, and even closer to 5 years, the fund has outperformed its respective benchmark. In fact, since the time the fund strategy has shifted to flexi cap, you can see a significant recovery in terms of portfolio performance, and the portfolio performance has come back in such a strong way that across various buckets, the portfolio has significantly outperformed its respective benchmarks. In terms of the top three sector allocation, we have financials, automobiles, and capital goods. In terms of micro marvels, since the month of April, the strategy has really made a strong comeback. After a return of about 25% in the month of April, the month of May was flattish, but in June you can see that the strategy has delivered almost 8% positive return. And with regards to the performance since April, the performance is up almost 34%. We believe that across small cap and micro cap, the liquidity across various stocks has seen a significant improvement, and that is one of the reasons why we thought that we'll sort of present you several reasons why this liquidity improvement is just a start and will sustain for a fairly long period of time. So now I'll hand over to Trilok to sort of take you through a lot of data points as to why we believe that this rally is here to sustain. Before that, let me also just cover pricing prowess, which is our AIF platform. If you look at the performance for the month, it's almost 2.5% up. And if you look at it from a 3-month perspective as well, the strategy has really delivered well with a return of about 15.3%. Over to you, Trilok, now for the topic of the webinar.
Yeah, hi, good evening. Good evening, everybody. Thanks for taking time out. So what we did was we tried to draw parallels between 2013 and 2026 because India, in a short span of 9 to 12 months, hasn't lost the value has not eroded of the currency so fast, so soon. These two were the right instances, on why and how we sort of, how we try to compare how India is fared now versus what it was in 2013. Uh,
Look, can I take a minute in between? Sorry if
yeah,
right.
yeah.
I think just to set the context. Thanks everyone for joining. I think while Trilok started, I think probably the most important concerns today in any investor's mind, both domestic as well as global investors from an India perspective, are twofold. One, the rising crude prices, which had become quite stable and which helped, I think, the GDP to grow much faster than before and much stronger. That has been, I think, a bigger challenge right since the crisis started in late February. Of course, it melted down in between and has probably again sprung back. And probably we might see again this happening on and off in the next few months till everything settles down. So that's the first challenge. The second challenge, which is related to probably the first challenge, is the currency depreciation and rather the rapid currency depreciation. And these two, I think, are hitting our economy and probably investor confidence the most. And so we tried to figure out when did it happen last. If you look at during COVID, the crude didn't move. Actually, crude went down because demand destruction happened, and that's why crude didn't do that well, and that's why that was not the parallel. But 2013 was the last instance when there was a similar situation where crude was rapidly rising and and rupee was depreciating as fast as you can see. And from that perspective, we thought that it's a very fair comparison as to 2013 and 2026. Alongside these two challenges, I think the biggest challenge from an investor perspective and from fund management perspective from our from our side is that for almost 1.5 years, markets have not done anything. I think if you look at till now from a 2 year perspective, the returns are sort of flat across mid, large, small, all the places. In between, in March, in fact, the drawdowns were much steeper. Large caps were down probably about 13 odd percent, and mid caps were down about 12%, and small caps were down 22% between September 24 and March 26. Similar situation happened actually in 2013, right? And probably we can draw parallels from 2013 and 2026 in the same fashion. Over to you, Trilok, just to provide the context. Thanks.
Yeah, thanks, Sushant, for setting the context. We will move to next because this is what exactly what Sushant has covered, that uh, how do we draw parallel in the two time frames. So essentially what we are trying to showcase here, if you look at the broader seven, eight, nine indicators of the economy, and how is the economy faring in 2026 versus the last time when the currency devaluated very sharply, you would be surprised to learn that, six out of nine indicators are actually faring better than what we saw in the previous cycle, which clearly reflects, not only the underlying economic indicators are strong, but also, this time around the policy intervention has led to significantly better situation than we saw in the previous cycle. Moreover, if you look at, despite so much of, commodity inflation across the curve, this time interest rate and inflation are well within control, unlike the last time where we saw significantly higher interest rate and inflation hitting us in the broader economic perspective. So the message out here is, between the two cycles, large amount of indicators are actually green versus, significantly red or difficult indicators in the previous one. Moving ahead, when you look at what's happening, can you, in the currency as well. So if you look at this, this is obviously released by RBI. The simple message we're trying to showcase here is India's currency value compared to global six currencies that are benchmarked, is meaningfully undervalued. This is there are only two instances where the currency went below 90. One was in 2013, in August 2013, and the second one is right now where we are seeing, the currency is nearly below 90 in terms of value. So our understanding, read through, outlook, belief, whatever you may say, so it clearly reflects that the currency has only been such kind of undervalued only twice in the last 2 decades. And we think it's a function of both what happened in externally, particularly the Middle East, Asia crisis or the West Asia crisis, and we think it's a matter of time where the currency will find its own feet before it, sort of reflects what's going to happen, unfold in the future. Moving ahead, if you look at what are the big issues that we saw in CY 25 or FY 26, I think so. There are no guesses for me, for there are no any price for any guesses. For the major important point here is the US has been the big challenge in the Indian context. The tariff that the US imposed on the country was significantly higher than other countries. B, the external factor, particularly with respect to energy, the serious steps the US is taking is only impacting countries like India. And C, that led to obviously replication effect of currency devaluation and FI outflows. So all three are correlated, intertwined, linked per se. And our view is all three, two factors, A, currency, B, and crude is obviously completely taken care of. We think with the incremental developments that we are seeing both between US and Iran, I we really do not believe that crude will actually will surpass its peak that we saw in the in the midst of key sort of differences between the two countries, which is as late as March and April 2026. The most important factor or the unknown factor is tariff, and even there, I think post the U.S. Supreme Court clear ruling of making tariff as unconstitutional clearly reflects that the stance the government in the US will take will be meaningfully softer than what they did last year. Moreover, India, similar to other markets, are obviously at less than 15 percentage points in terms of tariff. We don't see the outcome will be very different. Moreover, it's not about the percentage, it's about the certainty of what kind of numbers that we will progressively see versus uncertainty that we saw for 15, 50, 30, and so on and so forth. That will clearly reflect on how are we progressed and how do we think the going forward future will be. Moving ahead from what are the active measures that the government has taken. As I said, right, this time around, the proactive measures by the government to make it a pro growth sort of pro growth enable. One is we have seen a large amount of RBI monetary easing. Moreover, monetary easing that has also been led to large amount of liquidity boosting measures the RBI has clearly seen in the business, particularly in the markets. Income tax and GST both have been very, I would say, path-breaking reforms that the government has taken first time in the last 5 years that not only simplified taxation but also gave a large amount of boost to the consumption and economy. And lastly, this particular budget, the budget that went by, also was pro-growth despite significant constraint in terms of absolute amount of available capital to spend. The fiscal prudence were maintained. B, equity investments (PIO) was included and increased the budget. And C, a large amount of tax holiday was given to data center investment in the country. So all these four cumulatively are not only ensure that the growth comes back, but also will drive a lot of investments in the country, which were which were relatively muted, particularly in FY 26 as a whole and 25 as well. So cumulatively, our view is this can alone boost the economy by 100 basis points at least to 125 basis points going forward. Moving ahead, what are we seeing in the central banker action? Because this is what the government did. Central banker, obviously, there is absolutely great news. The central banker has announced is raising of FCNR bonds. We think this is similar to what we saw in 2013. One big difference is, unlike that time, the hedging cost is obviously borne by the RBI. Moreover, we think the absolute amount of quantum will be large enough and significant enough for the currency to find its feet. Moreover, you might see the net flows will be significantly stronger, similar to what we saw in FY 2014 and post November 2013. Government has also stepped in to ensure the cash flow stability remains for micro and small enterprises. What has happened is in the last 3 months, particularly March to May, the price inflation across the commodity curve led to two factors. A, the availability of the supply being constrained, and B, in cases where the product were available, the prices went through the roof. In both cases, if they sustain, it could lead to demand destruction. Thankfully, given that we are seeing some signs of talks between the two countries. Curve has already seen a correction and supply chain is normalized. In that context, the government announced a ECLGS scheme, which will essentially allow people, micro and MSME, to to basically take collateral free working capital loans that will ensure that the cash flow stability remains completely strong in the midst of such kind of external factor disruption. Moving ahead, when we look at what's the FCNR deposit that we are thinking, we think anything between 50 and 80 billion dollar is what the number should be coming in the country. The last time in 2013, this number was 26 billion dollars. So obviously, given the size of the GDP and also the appetite in the FX reserve, we think the number could be easily between 2 to 3x of what we saw in 2013. To some extent, the bond yields have started reflecting the benefit of the same. If you look at the bond yields have corrected by nearly 50 base points since the time this announcement has happened. And we think it's just the beginning of the net flows coming in the country from an absolute deposit point of view, and moreover, the comforting factor, as I said, when the currency finds its feet, although it's a vicious cycle, right? The flows started coming both FI and FTI, and the currency obviously you will see appreciation against the dollar, unlike what we have seen in the last 9 to 12 months time frame. Moving ahead, uh, what we see here is the FTA that is signed by the country. So obviously, if somebody has to term as FY26 as a year, it would be a year of uncertainty. FY27 will be a year of, I think so, significant amount of up move or traction in the export led by a lot of FTAs. So uncertainty to growth is what I would like to, put the year FY27 as, because FY26 we all saw what kind of, external news and uncertainty hit the business owners, particularly exporters. And we think in the next 12, 24 months time frame, given that the FTA that has been signed by the key partners, along with what will be done with the US and Canada, these cumulatively are 50% of net export of the country. So these are cumulative roughly around 190 to 195 billion dollars. And it would not only add to the clarity but also boost the exports from the Indian context to these markets. And we think significantly great traction will be visible in export businesses in FY27 and beyond. Moving ahead, currency devaluation obviously hurts to some extent in import inflation, but also makes a fantastic competitiveness for the country as a whole. Similar to 2013, when we look at, the currency, Chinese yuan versus INR also depreciated in 2013 by nearly 14 percentage point. This time we are at 15 percentage points, similar to what we saw that during that time. So not only did we obviously improvise on our competitiveness versus these countries, but also the FTA signed will be like a nail in the coffin. So we think this will also reflect some of the sectors that we have already marked here, which is reflecting in the green, have started to see positive growth in the first month of the data available right here, which is electronics, engineering goods, and chemicals and textile products. I think this is just the beginning, and you will see this number only accelerating as we proceed to FY27 and FY28 in totality. Moving ahead from exports competitiveness to what kind of fiscal deficit are we looking at? Because one of the big worry that the industry, investors, and the market had is what will the government be constrained in spending money given that crude has hit $100. Moreover, India being a net importer, what kind of cost subsidy that India has to bear? So now even at 80 $85 of crude, the net impact is significantly lower than what we would have seen. Nearly 4 lakh crore was the shortfall, would have nearly halved now as we speak. But most importantly, government had taken some near-term measures, which is A, GST correction, B, custom duties, C, windfall gain tax, these all cumulatively would have led to significant amount of lower, I think so, outflow, which would have lead to clearly matching what kind of revenue shortfall we would have otherwise foreseen. So our understanding is, despite such difficult situation, we wouldn't have seen meaningful slippage of the fiscal deficit, which is a great news from external FI investors, as well as stability on how one looks at India's balance sheet in totality. Moving ahead, economic indicators remain very resilient, contrary to the belief that India will slow down. India will obviously have a difficult situation given the crude is going up. In fact, most important indicators, whether it's automobiles, electricity consumption, credit growth, or moreover, non-mortgage growth as well. Everything, if you look at all indicators, are actually pointing upwards. Most of them are positive to, doing better, or in cases are just, showcasing clearly robustness and reflection of very strong inherent economic sort of underlying pillars. Moving ahead, this is something everybody is, sort of praying that the rain god should shower the country. So far, the deficit has improved, but we are still obviously way behind what ideally would have seen. So 10 percentage is what they expected for the full monsoon. We are currently around 15 percentage lower than what would have been ideally been so. But the good news here is, despite the El Nino years that we have seen over the last many years, only 2009 is where we saw double-digit inflation. In most other cases, we have seen inflation significantly lower than what would have been ideally sort of seen in the last many years. So I think this time around, my view and our view is that monsoon, even if it is deficit by 10, 11 percentage points, the water reservoir levels, the irrigation projects, and the controlled food supply chain that we have seen in the last many years, inflation will not go through roof, which essentially means that the RBI will not take a rate hikes, despite whatever we have seen so far in the monsoon development in the fiscal year 27. Moving ahead, when we look at the capex cycle, because this is very important, most people believe capex is more elusive in nature and not necessarily happening on the ground. It's more announcement and just postponement of capex. However, the data suggests otherwise. If you look at the top companies in the private sector, and if you look at Reliance, we are looking at this, data excluding Reliance, 3 year, 5 year, 6 year CAGR is 15 percentage points. It's a very healthy number, double in the low, mid double digit numbers. So the good news here is broad-based capex is happening, also led by a few sectors, which is renewable, semiconductor, and data center. We think this particular capex cycle will continue for several reasons. A lot of opportunity that we are seeing across the bucket, particularly in the semicon and data center space. And B, the focus of transmission and renewables will remain very high, which essentially means the power deficit for the country is going to sustain until FY 28, which is why all of these in actually getting accelerated. So our view is private capex is here to stay. Public capex and the Reliance will obviously see its up and down depending on what kind of cash flows they are working, what kind of focus they are working with. But broad-based capex is here, and we think it's only get better in FY 27 and 28. Moving ahead, what is the profitability given the fact that the capex is obviously moving up? You know, if you look at both listed as well as unlisted profit trend, uh, we have already reached to all-time highs in terms of profitability trend. So we were at 6.1, 6.2 percentage points in 2008. We are at 5.7 percentage in the listed profitability space. The unlisted numbers are yet to be out in 2026, but we think the numbers will be even better as we proceed further. Given the FY 26 full number is yet to be out, but we think it will be significantly higher, which will lead to the total universe of listed plus unlisted surpassing all-time highs. So CapEx, coupled with strong profitability, will ensure that their balance sheets are not leveraged and the growth will only get better as we progressively move forward. Moving ahead, I was saying that the leverage being low, so the data is here to see across the bucketing, large, mid, or small cap. The numbers are only showcasing southward trend. In fact, in the small cap space, the leverage have nearly halved over the last decade or so. Mid and large caps were anyways relatively better managed in terms of leveraging, but even in the mid cap space, the leverage is nearly halved over the last decade. So what it showcases the corporate profitability, the leverage positioning, the balance sheet, and the export capability. All four are getting aligned to only ensure the outlook is very bright. Moving ahead on leverage to earnings. The earnings is obviously after 6 to 7 quarters of relatively moderate, or I would say downgrade in earnings, we have seen an upgrade in earnings cycle witnessed from Q4 FY26. Moreover, we think Q1 will obviously be a quarter where you will see some effect of higher commodity prices. But we think the cycle, in our opinion, of downgrade cycle is behind, and we only think the upgrade cycle will only get more and more juicier as we proceed further. This is going to be a very, very important category catalyst for the markets because markets follows earnings and liquidity. We think earnings are back and liquidity obviously will follow as we proceed further. Moving ahead, the valuations are still very attractive across the bucket, whether it's large cap, mid cap, or small cap. In fact, the froth in the market in certain pockets that we saw a year and a half ago for several reasons, primarily, particularly with respect to large liquidity, is completely behind us, and we don't see any significant froth about in the market as a whole. Moving ahead, if you look at the valuation across sectors, uh, we know the sector valuation before the West Asia crisis broke out and after the West Asia crisis. In fact, a lot of the sectors are actually discount to their long-term averages, contrary despite the fact that the market has moved up, before if you plot between February 1st, 2026 to 1st July 2026, you will see a deep valley in the month of March, and then you see the recovery which happened in April. But if you look at from last 4 months point of view, despite the market moving up, the number of sectors trading below 10-year averages has actually gone up, which clearly reflects that the market is obviously not certain about the earnings in this particular sectors. Moreover, this also provides more opportunity during uncertain times to allocate smartly into sectors where we think earning growth will actually move forward, going forward, be better. Moving ahead, this is the valuation across categories, large, mid, and small cap. The last time we saw such kind of deep discount in the large, mid, and small cap was only in October, November 2013, similar to what we are seeing right now, where the currency devalued very sharply, where the FI flows were leading to high outflows, and also where the current account deficit was a big question mark given the external factors. Thanks to the recent developments, our understanding is crude is under check. Current account deficit will be completely taken care by the RBI intervention of FCNR deposits. And I think the growth will only get better and earnings will only accelerate as we proceed in FY27 and 28, which essentially means not only the valuations has a lot of headroom as we proceed further, but there is also a significant amount of earnings which is accelerated based on each bottom-up approach rather than broad-based approach that we are seeing, because all of the companies may not turn out as winners. Because please remember, after every disruption that we have seen over the last 1, 5, 10, 15 years time frame, only strong balance sheet and leaders or challengers with strong execution capabilities come out as clear winners, and not necessarily you will have spray and spray strategy that will work which you allocate into any businesses and you will make money at the end of the cycle. So I think I would like Sushant to obviously give his final thoughts before we obviously open the floor for Q&A.
Yeah. Thanks, Trilok, for sharing such a detailed presentation and lots of data points. So, as Trilok alluded in all these slides which we presented, the markets are giving a good opportunity. There has been almost close to 2 years of consolidation phase which market has gone through. We are probably on mid and small cap indices. We are slightly above their lifetime highs on in terms of large cap indices, Nifty and Sensex. We're probably 7-8% still below the lifetime highs. But remember, 2 years, almost 2 years have passed. Almost 6-7 quarters of earnings have passed since the previous hikes. So probably there was a bit of overvaluation in that time period. But in over the earnings of last 6-8 quarters, I think those valuations have got adjusted. Not everything in the index has worked in the same manner. I think there have been lots of stocks which have done well in the last 2 year period, and there are lots and many more actually which have gone down quite a lot. So there is a good opportunity for stock pickers in this market, and I think especially for PMS alternate players, I think it's a great opportunity to service their clients. And whatever time correction has taken place in client portfolios, I think as we have seen in the last 3 months, that the performance is coming back. Hopefully, in the next 6 to 12 months, lots of money making opportunities will be available. So we have been meeting clients, partners across the country to communicate these positives in this current mayhem of markets, and which has been testing the patience of investors across. And the only, I would say, missing link today, if you ask us, is the FPI investment, which I think has slightly picked up in the last month or so. And that's why probably you see large caps are still not that well recovered compared to mid and small caps, because they are more domestic investor driven. So probably that will take a bit more time to come back. But some fine day, as the AI trade reverses, as India becomes probably more valuable in investors' mindset globally, we'll start seeing those flows as well.